Here at McKinley Plowman, and I head up the finance broking department. Welcome to our McKinley Plowman webinar on property. It's our first ever webinar, so please bear with us. We may have a couple of technical issues during it, and probably will. So today we've got a good variety of speakers for you and a good range of topics on property. And I'll just introduce what we'll go through with a bit of an agenda. Today we've got Lachie Delahunty from Performance Property Advisory Group. They're one of McKinley Plowman's referral partners. You may have seen him running around CBAK Footy Club, and we're very lucky to have him here today because they won the grand final a week and a half ago, so I'm glad he's still sober now, Lachie. But Performance Property are a national group that provides services such as buyer's agents, sales advisory services, strategies to get higher income from residential property, and property management. And I think Lachie will be looking at property markets here in Perth and nationwide, and maybe some tips and suburbs to look out for. Then we'll have a finance segment, which will be myself and Paul Tate, one of the loan writers here with McKinley Plowman. We'll provide some information on finance, bank policy, what the banks are looking at now when you apply for a loan, and why they ask for it. Also something around the recent interest rate buffer increase that APRA introduced last week. The banks will start applying that as of November. Some figures on should you buy or rent, but also some good news at the end of it on some rates and bank offers as well. And then we'll finish up with the most exciting part of the presentation, which is tax. Ben Teddy, who's also one of our directors here at McKinley Plowman. He's a senior accountant and CPA. Ben's going to give some advice around differences between positive and negative gearing with some examples, and then finish off with some detail around CGT, some capital gains tax. We do just have to put a disclaimer in there, obviously, like always. Reminder that this information is general advice only and does not take into account your personal situation. Please consider whether this information is appropriate for you and your needs, and where appropriate, seek professional advice from either your accountant, financial advisor or finance broker. Now, you may have questions during it as well, but we just ask if you leave those to the end, and with Teams we believe you should be able to enter a question at the end, and those we can do within the time frame we'll get to. Those we can't, we'll come back to you via email. So yeah, let's kick it off. Lachie, if we'll start with you.
Thanks, Paul. I'll jump into the presentation, which Ben is running behind the scenes there, so if we can jump in. What I'll touch on today, obviously the last 12 to 18 months has been pretty substantial in the property markets across Australia, and navigating our way through the current climate is difficult. I think everyone's aware it's very much a seller's market. But probably 18 months ago it was very much a buyer's market. So the shift has occurred quickly. So what I'm going to touch on mostly around Perth, but I'll look at national, sort of what's happened nationally as well. But we'll dive into really around what's happening locally here. And I'll start by sort of how we got here, and if I jump into the next slide. An interesting presentation on reflection when we do these. I always look back to its previous presentations for the Plowman Group, but also others. And one I did last year, it was June. This was one of the key graphs that we referenced. And at that time, COVID sort of just instigated, or was very much, very unsure nationally and internationally what was going to occur. But it sort of paints a picture of what happened, and also potentially what continued to happen over the next sort of 3 to 4 years. But this is the national house price movement across essentially since 1970, and taking into consideration key economic events. So we look back at the dot-com crash, GFC, major recession, and this was one of the power slides that we spent a fair bit of time on in that June presentation. And it was pretty an interesting time, because it's all good and well to do a presentation when the markets are going well, and our advice is plain and simple. But at this time, our clients were very unsure what to do and what to do in an uncertain market. But our advice was pretty clear at this time, and that was to hold property, ideally not to be selling, and to sort of make sure your cash buffers are high, and if you are purchase with cautious. But the advice was that if we look back on these trends, if you go on to the next slide as well, you can see what happened in Perth over the last 5 sort of recessions. And what's interesting nationally and specifically in Perth, that post each economic event, there was actually quite a surge in house prices, not only for the corresponding 12 months, but then 3, 4, 5, 6 years after that. So not that this is black and white and we're forecasting 5 to 6 years of positive conditions nationally, but it's interesting when looking at Perth, it's not necessarily, or at the time wasn't necessarily the doom and gloom of the property market, but actually in fact that it could open up some opportunities. And when we look at Perth specifically, it's typically not a 12-month window. There's actually some legs in the market post that recession. But moving forward, I suppose the best way to look at Perth and the national markets across Australia, you can see that the 12 months was pretty significant. All capital cities, the median house growth over the last 12 months up to September 30 was 19.5%. So that is certainly significant. When you look at Perth at 18%, it's probably underperformed in comparison to some of the other cap cities. But certainly we try to measure where the markets are currently at and where they're going. And obviously some of these markets, if we move forward to the property clock, are certainly getting close to their all-time highs in terms of affordability. And better if we can just flick forward there to the property clock, you can see double click and it'll give you the long-term compounding growth rate. But as you can see here, the Melbourne and Sydney markets are getting back to their sort of, almost past their previous peaks, which is interesting in the sense that obviously APRA have now stepped in, and I'll leave the Paul's to speak more about that and the implications that may have and what APRA are trying to actually do there. But obviously it's to put in place to handicap the affordability of Sydney and Melbourne, because they are getting to a point where it's really difficult for entrance into the market to participate. Sydney now is the price to income ratio is closing in on 12 times. So they haven't been at those levels. Back in 2017 was the last peak, and it was about 11.5 times. So we're pushing past that. So in terms of how far do these markets have to run nationally, if you look at Sydney and Melbourne, there may be another 6 to 12 months before they really look to get to a point where we believe as a business they'll start to tap out. But there's other markets around Australia that certainly have legs, and Perth, for us as a business, and it may surprise a lot of people that we have it that's early in the cycle. But really, when you look at it, we're about 18 months into what we believe could be a 4 to 7 year cycle. So very early days in that particular growth cycle, and having 18% uplift is great. But understand we've had 13 years of stagnation behind that, and our last 2 cycles of growth, Perth exceeded 100% growth during those cycles. So the view is that, but I'll dive into the data as to why we form that view. We don't just pull it out of a hat. And the way to sort of best define Perth is the supply and demand equation. I think if anyone's participating in the market at the moment, they're finding it very difficult to source property. There's just over 8,000 properties available to purchase across Perth, and understand back in 16, 17, this was as high as 18,000. There's no wonder that people are finding it really difficult. But there's a few reasons for this. And this is the first slide to sort of demonstrate the supply side of the equation, looking at dwelling approvals. As you can see, we're there when in 2014 through to 16, when the properties on market were circa 16 to 18,000, it was around sort of 30,000 property or dwelling approvals per year. Pretty significant. At the same time, interstate migration and overseas migration was on a decline. So we're building more properties during this period, and there certainly wasn't the migration or the population to support it. Since then, even last year with a huge building surge or building incentives to encourage more approvals, there was only just over sort of 15,000 approvals. So still half of the peak in 2014. So we've had 7 years essentially of declining approvals. And if we flick forward, the population growth at the same time is on the rise. In particular, when you look at the national population growth, Perth is exceeding that. And when we look at, I won't go too far forward yet, but we look at job vacancies and some of the forecasts of when borders do open, and we probably don't expect that this year. And some of the figures that were coming through or still coming through for interstate net migration, they're all really, really positive. So it is looking like we're going to see an influx of population into Perth, into a market where there is limited supply. Understand there's sort of a bit of a logjam of construction because we can't get trades in, we can't get materials in. So bringing on supply is more difficult than ever, and trying to build projects or build supply quickly, it doesn't happen. When you've got to understand there's typically a 2-year lay period between when a plan is put together and when construction is complete. So, and that's for the larger sort of high-rise buildings. Understand for residential dwelling, it's typically 12 to 18 months. So there's no sort of quick way to bring on supply, yet there's significant demand in the market currently. There's also a potential surge of immigration sitting there in the background waiting for the borders to open. When we now look at demand and solely on demand, if you look at average days on market, typically Perth is around sort of 50 to 55 days on market. If you just click forward, Ben, you can see currently in September, just look back, it's 16 days. So that slide, there's one mishap on the presentation. It's currently 16 days on market. So it's just showing you that the level of activity in the market at the moment is certainly at as higher levels than we've actually seen. Even when we look back to 2006, 2007, when the market did, 30 to 40% in a single year, even days on market at that point in time was only at 40, and we're currently at 16. Fast track to the next slide, and you can see this is realestate.com's weekly demand index for buyers. So what this tracks is highly engaged users on realestate.com. So this is not necessarily clicks through properties, but this is time spent on realestate.com, featured properties saved, so highly engaged user activity. It provides a long-term average, a basis point, and then indicates where we are at currently in the buy cycle. And as you can see, some of the conversations having with agents and potential clients, there was a bit of a feel in the market that had softened over the winter in terms of buyer activity. We weren't seeing it. Certainly in the markets we're buying in, we weren't seeing that. We're actually seeing quite the opposite. We're seeing still significant price inflation. And when we look at the data, and this is probably the most live data set that we've actually got in terms of week-to-week buyer activity, again, it's at the highest levels it's ever been. So we look at it, it's almost 70% above the long-term average. And when we even look back to peak times at the start of the year, when March, Feb, when things appeared to be extremely hot, there's more buyer or engaged buyer activity on realestate.com now than there was 6 months ago or even 12 months ago. So interesting to see. And what does this equate to? Typically more numbers at home opens, more inquiries per property, more offers, and typically what we see is a competitive result, and that's typically reflected in the sales price. But moving forward again into the next slide, vacancy rates is something that we look at quite closely. And as you can see, when we compare national cities, and I've touched on this slide before, but we haven't quite seen a data set that is almost like Mount Everest in terms of a vacancy rate. So 1670, when some of that building supply was coming on, obviously there was an excess supply in the market. Vacancy rates skied and it skied up to, in 2017 actually peaked at almost 6% in that calendar year. Now we're down to 0.9 and there's less than 2,000 properties available to rent at the moment, which is really putting a lot of pressure on yields and rents. So we've seen an increase in rental prices, quite a significant increase, almost 35% in the last 6 months, which has improved yields. So national yields at the moment, buying in Sydney and Melbourne, you're sort of circa 2 to 2.5. Even Brisbane and Adelaide, circa 3, 2.75 to 3.25. A lot of the properties we're buying in Perth at the moment are 3.5, even 4%. So that's becoming extremely attractive for East Coast investors that have now been either priced out of the East Coast or the rental shortfall is $2,000. So therefore they're looking at other markets across Australia, being Perth, as this rental increase continues to grow because of the scarcity of rentals. It's going to become more attractive for investors, and our forecast is once those borders opened up and travel is allowed, then you're going to start to see some of this migration come in to buy up quite a substantial amount of property here in WA. But moving forward, next slide is affordability, and this is what I touched on earlier. So if we go into the the Perth price to income ratio, the next slide is Sydney, but we won't go there yet. We'll sit here and we're currently at 5.2 times, so price to income ratio, which is a long way off our 2006 peak of 7.5. The concern with Sydney, if you go to the next slide, and this is to give you context of how affordable Perth really is, this is from March. Now fast track to September, Sydney's now closing in on 12 times, so they've had a significant surge in price activity. But now it's getting to the point where they're north of their 2017 peaks of 11.5 times. So that's a market that we see is starting to tap out. When you look at WA, at 5 and a bit times, it's certainly a long way from its peak, and that's why we talk about legs in a market in terms of how much there is left in the market. We still think we're early phases based on affordability. Same is true when we flick forward to the affordability index. And if you look at it currently at 21, so this was in June, it's now clicked over to 22% with the release of RP data, median house price. So at 22%, so the average wage consumed by the average mortgage is 22%. So extremely affordable. To give you context, flicks to the next slide. This was Sydney back in 17 when it got up to 60%. So when 60% of the average wage, they're now closing in again back to 52% based on where the median house price is at the moment. So when you get into that point of unaffordability, it becomes very difficult to get into the market, and it's not sustainable. When we go back to Perth, if we could, if we look at where we're currently at in terms of where we've been, we're still a long way short from our 2006 to 2008 high of 57%. So we haven't been as affordable on a local standpoint since really the late 90s. And this just gives you really some relevance around where prices can get to, and people are sort of shocked at some of the figures that are coming through in some of the more blue chip suburbs that are breaking records sort of month on month, and we're getting some really big numbers come through. But even based on if prices are to surge by 50 to 60%, from an affordability point of view, in terms of repayments and the average wage consumed by that average mortgage, it's going to be substantially lower than where we've been into the past. So the ceiling on where this market can go, we're still a long way from that. We're a third really from where we've been. So in terms of trying to forecast where that ceiling is, it is difficult. But based on this data set, it's untapped at the moment in terms of where we can go. And the only things that can really shift this is A, wage growth, B, significant increase in median house prices. But again, that alone won't change it. Interest rates is the other factor. There would have to be a significant increase in interest rates for this to become an issue in the short to medium term. But flicking through the next two slides, because I won't bog you down in all the research because we need to get through quite a bit. But if we look at the confidence in the market, when people look at jobs, there's typically a lot of confidence in the market, but this is really interesting when we look at job vacancies and talk about that interstate migration numbers. And Perth for the last 5 years in the lead up to 2019 was actually quite negative, but now we've almost got 50,000 jobs currently vacant and searching, and that's really led by the mining sector, also construction and healthcare, sort of leading these vacancies. They become really attractive for both overseas and interstate migrants when you look at some of the wages that have been put forward, particularly in the mining space, to encourage people to move across. So this is definitely significant when we compare to our last peak in the market back in 2006 and 7, but also in 11 and 12 when there was a shortage of skilled labourers and also professionals in the market. We're almost nearly closing in on double that vacancy. So these jobs need to be filled, and it's difficult to do that locally. So will start to attract interstate and overseas talent, and to do that, it'll be sort of led by wage growth. So when we look at it, how many properties are actually available in the market right now? When you look at this sort of 8,000, circa 8,000 available to purchase, just a touch over 2,000 to rent, you're looking at a combination of 10,000 people or 10,000 houses that people can move into. If interstate migration numbers pan out the way we predict, there's going to be a significant shortage of dwellings. So what does that do? 50,000 doesn't go into 10. Even half of these sort of jobs were fulfilled. 25,000 doesn't go into 10. So what's going to happen? Our sort of forecast is there's going to be a significant shortage. Therefore, people have to pay a premium for the privilege to have housing, be that to rent or be that to purchase, because a natural increase in migration in terms of population growth doesn't put pressure on pricing, but certainly interstate and overseas migration does. So that's certainly one to watch. And the other thing when we're looking at confidence, if you flick through, is some of the lending data that's coming through. And I understand the Pauls will speak about this, but it's an interesting one to throw in there. So this was the lending data, and it's a three-part slide, but the correlation between lending activity and median house prices is pretty much a correlation of one when you look at increased in lending activity from circa 2010 through to 2013. What followed was a 12 to 18, it was really an 18-month lag in median house price movement. So lending activity increased. 18 months later, we've seen an increase in median house price. Then we've seen a significant decline from 2013 right to 2020, pretty much COVID last year. And an 18-month lag, we started to see median house prices follow suit. Fast track to sort of December, January this year, what we've seen was a significant surge in owner-occupier lending activity, which was figures that we hadn't seen before, and quite scary, really, in context. So you probably didn't have to be an economist to realise what may follow suit based on the current trends that we've seen here. And if we flick forward to the next slide, it exactly panned out probably how one would predict, and that's median house prices started to follow suit. Since that point in time, the dip in activity, there's obviously Christmas and New Year activity. We've seen an increase back north of this to March 2021. We don't have the latest data sets to September, but what was interesting when reviewing this was the investment appetite. So investment appetite we haven't seen really in the market nationally since 2017 when APRA stepped in to stop that city market, and a lot of that was investment lending activity. But in Perth, we really haven't seen this since 2012, 13 and 14. What we're starting to see locally, and certainly from a business, a buyer's agency business, is a lot of interstate inquiry, particularly because the yields are so attractive. So I think the next surge in activity will be certainly coming from an investor play based on some of these data sets in comparison or side by side with owner-occupier activity. So at the moment, we've really only been seen in the local market owner-occupiers competing with other owner-occupiers. If we add another layer of investors into the mix, it's going to become even more difficult to buy property, and it's going to put significant pressure on house prices. So if we skip forward now to summary of the Perth market. This is just an overview, and as always, we'll share our updated Perth report with everyone who's attended today. But you can see overall, Perth is still very well positioned and very much, we believe, certainly early phases in the cycle based on these 6 key pillars that we track and continue to track in the market, and they continue to improve, as particularly around the employment space and population growth when forecasting what may or may not happen when borders open. And if we flick forward to the summary or the snapshot, as I said and I've touched on quite a few times, listed for sale, the same week last year, there was over 10,000 properties available to purchase, and there was over almost 3,000 to rent. We've seen a significant reduction with a lot of activity that's occurred over the last 12 months, and now we're at 8,500 to purchase and just over 2,000 to rent. So this is where we're at currently. Based on some of that buyer activity that we're seeing, we don't forecast a significant amount of supply to come onto the market. If it is, there's certainly enough activity there for it to be absorbed quickly. So we think this is going to be continued stress in terms of that supply-demand imbalance that we've currently witnessed over the last 12 months and probably what is frustrating a lot of buyers in the market at the moment. But we'll jump in now to a bit more of the strategy piece on how to navigate this, because I know for many of you it may be quite frustrating. It's unfortunate these slides haven't come together how we would, but I'll work with it. So these are typically this is for an investor seminar, and whether you're owner, occupier, investment, this will still be really relevant for you. But at the moment, we're actually buying in 36 suburbs across Perth for investment. This time last year it was about 17. So certainly with the market, as the data continues to improve on a suburb level, we activate more suburbs to buy in, and we follow the data religiously. So I won't bog you down in the detail as to the specific data sets that we track from the suburb level. Just understand there's a process that if you are looking at that from an investment point of view, there's typically a process that should be taken. If I jump into the next slide, and this is going to be more relevant to particularly the owner-occupiers that are listening, it's how to source essentially from a point of finding properties in a market that is notoriously different. And as a buyer's agency business that we have, buying off market, pre-market, finding stock is really our mechanism to get and purchase properties well and to avoid overpaying. So there's a number of different ways to do this, and I'll touch on a few of them today. But obviously, in terms of, if you can go back, sorry, I just want to go through some of those options. And one of the keys is when negotiating on any property, whether it's on market or off market, is trying to navigate the conversation away from price. When talking price and dealing with agents and only speaking about price, it makes it really difficult to buy well, in the sense that that's the only thing the vendor will look at. That's the only thing that the agent will consider. But often behind the scenes, not always, there is often the case where the vendor just wants the highest price. But if you can dig a little bit deeper in your dialogue or your conversations, it's finding out what else is going on behind the scenes. And we've had some huge success as a business where we're buying now 20 properties a month, of which 70% of that is off market. So it isn't easy to find. So we spend a lot of time trying to find that stock, but then it's negotiating. And often our conversation goes around terms and conditions. So what's important for a potential seller, and sometimes it's having more time in a market where it's difficult to find and rent property. The biggest challenge we're seeing for potential sellers at the moment is they're scared to sell because they've got nowhere else to live or nowhere else to potentially rent. So giving them the luxury of a rent back, giving them the luxury of a long settlement, giving them the luxury of a free lease back, making it an easy transition for them can be more attractive than the price. And it won't happen always, but certainly our best buys looking back over the last 6 months have come from creating a solution that wasn't price orientated. It was actually about trying to give them enough time to make their next decision. So we've had some really good results in that space. As always, owner direct and rental properties have been a huge success for us in trying to navigate the off-market stock. Silent listing and pre-market listings are getting more difficult as the market's getting hotter, as agents want to get their exposure level up, as they're not carrying a lot of listings as well. But certainly, looking back in some of our pre-market purchases have been some of our best buys as well. So just things to consider. It's difficult, and I understand it can be frustrating for buyers when it is a seller's market. But keep in mind that there is more to a negotiation than price. And when you are just dealing with price, it's whoever's got the deepest pockets, and you can get yourself in a bidding war. But it's important that during that process that nothing's missed. And if I jump into the next slide, due diligence still forms a huge part of this. So making sure that you don't get caught up in the craze, and that typically can be quite an emotional process. What we'll see is typical buyer behaviour is they'll start with all good intentions, they'll have a really good checklist, they'll have a really good process. Then after they've missed out on 5 properties and inspected 50 or 60 and are constantly rocking up on the weekend and seeing run into the same family or friends or same people at the home opens, it becomes an awkward interaction for everyone involved. They just start to lose patience. And then that very last property, that when they've had enough, they will bid well and beyond their means, or well beyond what the purchase price needs to be, because they've lost patience in the process. And unfortunately, sometimes the due diligence items haven't been ticked, which this forms part of that. And then a mistake is made. Once purchased a compromised asset, you always carry that compromised asset with you. So it's important that at the very least that these items are ticked off, everything from zoning and council overlays right through to housing commission, easement reviews, adjoining uses, flooding. Who would have thought that Perth would experience flooding? But anyone who owned a property during June or July, I'm sure certainly were nervous. So this was important for us because we had a lot of properties in the Bayswater Mainlands area, which we didn't proceed on because they were actually in the flood zone. And during that flooding, there was a lot of properties that were damaged. So it's important to follow this as best you can. If I flick forward, and where necessary, look at elective due diligence. So another one that you should have serious consideration to, particularly if buying established dwellings, which obviously we recommend for investment, but non-conforming structural uses is a real big one in that space. If there's been a renovation that hasn't been council approved, a kitchen, a bathroom, patio, etc., understanding where that is and what it's going to cost to rectify is important. Electric audits, plumbing audits, survey plans, net testing, very unlikely, but probably 1 in 1,000 properties will have this done to make sure that there's no issues with the property. Next slide, please. I won't dive too much detail about our specific process, other than the fact that having a process is really important in buying a property. And our process is, as you skip through, having a checklist, which I recommend all buyers to have. And this is our investment reports that we go through, and it allows us to compare property to property, like for like, on 30 key grading points. So we can formulate really an objective assessment on the property. And that allows us to take the emotion out of it. When buying for investment, there should be never any emotion involved as possible. So having that checklist allows us to do that. Also, understanding the cash flow, as always, can you afford the property? What is it going to cost you on a worst case scenario? So stress testing interest rates, etc., is also important and forms part of this process. And pricing, and it's difficult, and this is probably my only advice when pricing in a market that is running the way it is at the moment, is making sure that you've got as much relevant data as you can possibly have. And if you're looking at data that's 3 to 6 months old, you will never buy in the market because it's so outdated. Even 3 months old now, it's really outdated. It's finding out what's under offer and what that's sold for. Having data that's 1 to 2 to 3 weeks old is the data that you need to make an informed decision, because that will get you buy ready to be able to make an informed decision on the particular property you've inspected, not the data that occurred 3 months ago. And if you keep looking at that, of where the market's been, you'll never buy, because it's going to be constantly at a level of regret. But understand that this time next year, I'm sure you'll be thankful that you've got into the market, undertaking the process of due diligence evaluation that you have at this point in time. So that pretty well concludes the research and strategy. This is just a snapshot from our point of view of what a process looks like when looking at investment property specifically, and that's undertaking macro research from a national point of view, right through to suburb selection, property selection, running the due diligence, valuation, negotiation process, and then reverting back to that until we've successfully secured a property. And then the post-transaction process from there is really, really important. And that's us in a nutshell, our business. Like I said, and I suppose Paul alluded to, everything we do is backed by the data and the research. And I think having a process to do that's really important, whether you are to use our services at a point in time or do it yourself. The key to take away from today is really just making sure you've got a process. So then when you are at that 10th or 11th property and emotion is running high, if you have a checklist that you stick true to, then you should protect yourself. And that's really, really important. So I think I'll leave it there. Any questions, you've got my contact details direct. Obviously, I'll be hanging around for the panel session. And if you want the reports, please reach out. But we'll aim to get everyone who's attended a research report today as well.
Yeah, no, thanks, Lockie. Appreciate all that. There's some great information and tips there. And all the slides will be available to the attendees next week or later this week. Looks like there's some potentially some great potential in the Perth market. So hopefully this will help you achieve some of your goals if you're looking at property. So we'll kick off the finance slides and get onto that. As I mentioned, we'll take you through some information on bank policy and why the banks have introduced these. So if we can start it off, please, Ben. And Paul, I'll let you kick off.
Okay, so hi everybody. Firstly, I suppose one of the most prevalent things we see in the marketplace is person's starting point, starting age, and how close or otherwise they are to retirement, or at least a bank-derived retirement age. Generally speaking, they call it exit strategy, but what we're trying to do under responsible lending, or what the lenders are endeavouring to do, is just to take into account the ongoing nature of the income and also the ability to service a loan either now and into the future.
So essentially, if you're a retirement age generally of 65, if you're looking at you're currently 30 years old and most loan terms are 30 years, then you'll be paying that loan off prior to retirement. If you're 55 and looking at getting a 30-year loan, then obviously you're looking at 85 and looking at retiring well before the loan maturity. So as Paul's alluded to, the person's age will go beyond the loan term or the retirement age, the loan term will go beyond the retirement age as such. So the banks are asking, well, how is the client going to repay that loan prior to retirement? And that's where your exit strategy comes in. So Ben, if we can go to the next one. Yeah, some of the options that we look at as far as exit strategy, and this is something we discuss with our clients because it's not something you're forced to do at all. But other income streams such as external investments, investment property, superannuation. If you've got a large amount of superannuation, then that can be considered as part of your exit strategy. Other pensions, those type of things, downsizing of your home. Anything else you can think of, Paul?
No, that's pretty well in a nutshell. I mean, there are some niche examples as well, but that's predominantly where they're looking. And perhaps we look through to the next slide as well, Ben. So I think we're also seeing a softening here, or a little alteration in that 65 used to be retirement age. I think a number of lenders are going to 67, which is the new Centrelink age. But even so, that's only adding another couple of years. So if you're a 55-year-old looking to commence a loan, paying off a loan within a 12-year time frame versus a 30-year standard time frame, that's the equation that we're here to help and guide you through. There are some lenders that are a little bit more accommodating is not the right word, but understanding, I suppose, of different strategies, and some lenders which we know about are certainly not, don't have an open ear to any of those niche or different exit strategies.
And the banks are less strict, so to speak, on investment property purchases, because part of the exit strategy with the lenders, as we mentioned in the previous slide, was sale of the asset. So if it's an investment property and you've got 20% equity which you're putting in with cash or whatever, then generally sale of the actual investment asset, investment property is the exit strategy itself. For home loans, it's a little bit different, because the banks don't want to be you're looking to sell your home unless it's downsizing that home to try and get its money back from you. So yeah, there are different strategies as far as home and investment property loans. The next slide that's come up is regarding why the banks made these changes, and Lockie alluded to these as well. There were some APRA changes initially dating back to 2014, where APRA introduced some strict measures on the banks to ensure that there were more owner-occupied purchases and reduced the demand for investment property purchases. And it was mainly driven by the Sydney and Melbourne property markets growing at a 20% each year. So they introduced requirements that no financier could have an investment portfolio growth greater than 10%, and no new interest-only lending had to be capped at 30%. It's something we've seen a change in clients' position now, and with accountants as well. Previously, the preference was to have interest-only lending for 5 years, and that maybe went to 10 or even 15 years. Given the rates of loans at the moment, quite often we're starting clients with investment property loans off on a 30-year term with principal and interest repayments. The difference in the tax deductibility is minimal, but you're actually you're reducing your debt. And it's just a good result for most clients, because, as I said, the principal and interest rate is lower than the interest-only rate. So there are some benefits there. It's not saying we can't do interest-only loans for clients, but it is a little bit harder and a little bit more strictly controlled by the banks. Some of them have now been lifted, some of these caps or restrictions that APRA initially put on, but a lot of the banks have kept them in place because they were made to be permanent in order to strengthen the overall lending standards. Next one, please, Ben. Some of the changes that the banks made was investment properties used to allow to go up to 95%, though it was reduced to 90% of the purchase price. There were postcode restrictions. You're probably aware of the bust and in Karratha and Port Hedland with property prices, then sales. So that was reduced down, with a lot of banks still around the 50 to 70% lending ratio against those. Discounting of rental income. So even though you may be getting 500 or 400 a week rental income, the banks will only allow 75 to 80% of that actual rent when they calculate serviceability. Some lenders don't allow the inclusion of negative gearing. Living expenses, which has become a big thing and has been really introduced in the last couple of years, where the banks really want to see a detailed living expense worksheet and quite often confirm that with your transaction statements. It's become a bit onerous for clients and us as finance brokers, but it's a requirement that all the banks are really enforcing.
Yeah, the level of detail there is actually getting quite specific, and yeah, we're finding that most clients, as Paul alluded to, resent the fact that it does get quite so detailed, but nevertheless that's the new normal. So we have to, on behalf of lenders, probe quite in detailed format just to find exactly where normal expenditure is going, little loan rent and or soon to be servicing of a home loan.
Yeah, and interest rates have been sensitised, and I'll bring this up in a second as well because that's just recently changed with APRA. But previously it was the rate plus a margin of 2.5%. So whatever rate you were getting from the bank, say currently maybe 2.5, the bank would add another 2.5 on it, or they had a floor rate, a base floor rate, which most of them had around the 5.25 mark. Which they were enforcing anyway, and that was to ensure that clients can obviously make their repayments into the future with any future rate increases. Another change that came through was all loans now are assessed on a principal and interest basis from a serviceability point of view. Even if you have 2 or 3 investment properties and they are an interest only, you're looking at a new loan, then the new bank will be assessing those existing loans on a principal and interest basis. And again, just interest-only loans, again, they're more heavily scrutinised as far as banks used to allow the actual repayment, the interest-only actual repayment, but now it's calculated for serviceability purposes over the remaining term of the loan. And again, as I mentioned up above, rate increases on investment property lending compared to owner-occupier lending are anywhere from 0.1 to 1% higher depending upon the bank. Next one, please, Ben. Not all bad news, though. I'll let you go through one, Paul.
Oh, so just I suppose everyone's aware of the all-time low rates at the moment. That's both on variable, but certainly on some fixed rates that you'll see heavily advertised by the majors and some of the second-tier lenders now. Especially on owner-occupied, but certainly if we're talking investment and combination with owner-occupied, which many of certainly the clientele that we have here at McKinley Plowman have, some rural super rates can be achieved across the board. 2% we're seeing, or the low 2s for variable. There are a couple of outliers there that were below 2, but they're for quite specific properties. And also the fixed rates now, I think we saw again the 1.79% for 2 years. So that's round about where the market sees itself at the minute. The incentives, I don't know whether Paul wants to take the running with this one, but
yeah, so a lot of the banks are paying refinance switching costs where around 2,000 to 3,000. We saw one the other day. Citibank are actually paying up to 6,000 to not just refinance your home loan to them. Or investment loan, but also for any new purchases. That's for above $1 million, so there's always little conditions that that apply. Most banks waive application fees nowadays, no real valuation fees. The only point on that I'll say is the banks do have valuation fees sometimes if they consider it to be a luxury property, and they all have different thresholds on this, but generally above $2.5 million, there will be a valuation fee need to be paid. So yeah, but we have seen a change in the banks. They are becoming more engaging and trying to make an application work. I think the last 5 years, particularly in Perth, we all know the market, and it was subdued in the property market, but also the lending market. So yeah, we can look at reducing credit cards or cancelling a credit card to fit serviceability. And some banks have just recently introduced allowing you to access a personal loan to borrow to meet the additional 20% deposit, which previously was very taboo. Essentially, also, there's a couple of other things I wanted to point on. The first home loan deposit scheme, which for investors you really don't have access to, mainly for first home buyers. There was a couple of schemes introduced, the first home loan deposit scheme and the new home deposit scheme, and that's where the federal government will basically guarantee 15% of the purchase price, and that allows first homeowners to get into the market without paying mortgage insurance. Now, these have been around since I think about February last year, and they get reintroduced around every 6 months because the number of positions available get taken up very quickly by first homeowners. But there are still a few spots available in the new home guarantee, and some of the banks still have spots open in the first home loan deposit scheme, which is for established homes. They did also release a family home guarantee, which was a new release this year, in June this year, which is basically for single income earners with a dependent below 18 years of age, or a dependent who is disabled under 22. And that allows them to get into the market with only 2% deposit. And that can be mainly useful to some divorced couples who want to keep the family home, with one of the parents looking to keep the family home. And that can be particularly useful in that situation. Next one, please, Ben.
So I thought this was interesting that was raised by an earlier guest as well, but it's cheaper to buy than to rent. For the first time in a long time, that's starting to be the motto, and certainly in the West, both in regional WA and Perth, that scenario is becoming the norm. So it's risen significantly, I think, in the last 12 months, and even the 12 months preceding that. Rent is starting to take off because I think of the factors that Lockie outlined earlier, and he's more the expert on that side than my good self. But it's just important to note, particularly for the first home buyers, that they are certainly aware of this and trying to jump onto that property ladder sooner rather than later, because the squeeze is on. It's below 1% vacancy rate across the board. So if they can afford to get into a situation where they're paying less in their monthly or weekly loan repayments than they would otherwise be for renting a similar sort of property, then no time like the present.
Probably if you look at the next couple of slides, and it really outlines that. Ben, if you can change over, and yeah,
we've got some more specific. I've highlighted the ones to do with West Australia, and I know we've got some eastern states centric investors and clientele tuned in as well. But particularly if you looked at the Perth one, I mean, the regional West Australian one, well, it's just jumped a little bit ahead, but the regional West Australian one is quite solidly they're better to buy than to rent, as compared to, say, a Sydney. When you look right down the bottom, it's far better to be or more affordable, let's say, to be renting than buying on a similar sort of time frame. And Perth now is getting quite equitable, either the buy versus rent situation, and that'll only tighten further, we believe. What that means or has meant, so the median house price in Perth, or home value in Perth, is $525,000. That's a significant increase. And we're also aware that it makes it more challenging, if not difficult, for first home buyers. But the winners here are anybody with some equity already held, so some skin in the game with an existing property, either the upsizes, the downsizes, which we're seeing more and more of, and those just moving elsewhere, just packing up and selling from perhaps the Sydney market and moving across to Perth. Once we see those borders open, that might only accelerate. So they're just some interesting observations. Ben, you can go on to the next slide now. I think that sees me out.
Yeah, I think that's us done. We'll leave that at the moment, and then we'll just switch over to Ben Teddy, who'll go through some information, as I mentioned before, on the tax position.
All right, good afternoon all. My name is Ben, as Paul mentioned. I'm one of the accountants at McKinley Plowman, and I'll be speaking to you about tax today. So definitely save the best to last, strap yourselves in. Now, what I'll be covering is basically positive gearing, negative gearing, and a bit of CGT. So a lot of this subject dedicate a whole day to itself. So I will be just covering on a very basic level. So hopefully it's not just a refresher for you, get some really good content on this, but probably just emphasises a need I suppose, of professional advice in this space, just purely because it is a minefield and everyone's circumstance is different, whether it's types of properties you buy, the dates that you purchase them, as well as your intention as well. Intention, whether it's a long-term investment or short-term, has really, really contrasting tax implications, which I'll cover off towards the end. But just to kick things off, I'll just explain the difference between positive gearing and negative gearing. So positive gearing is basically when your deductible expenses are less than the income that you earn from the property, resulting in a net rental profit. So this is the ideal position. You're making money. So this rental profit, from tax purposes, is added onto your income, overall income. So your wages, salary, business income, and relevant investments and things like that, and is subject to your marginal tax rate. Negative gearing, on the other hand, occurs when your deductible expenses are more than the income you earn, so resulting in a net rental loss. So you do get a tax incentive as a result of this. It's used as a tax deduction against your other sources of income, being your wages, salary, and business. So there is that small incentive in there. However, if we just move on to the next slide, is so what should I be working towards? The ultimate goal in investing, whether it be property, shares, or anything else, is to be positively geared, because that's when you are effectively making money in those investments. Really good opportunity at the moment, as the two finance boys mentioned, with the interest rate cuts over the last few years with the Reserve Bank. It really presents a great opportunity for people to achieve positive gearing, purely because your interest expense on your loans is typically the biggest outgoing of your rental investment. So certainly when you do first invest in property, it's quite common that the investment is negative geared just due to this interest on the loans, maybe a bit of depreciation, i.e. the wear and tear on the property and the fittings, as well as the other expenses, which is not a bad thing. As long as you have a long-term strategy to be positively geared, it can work for you. Where the big misconception is that a lot of questions I get from clients is like, well, shouldn't I be negative geared because I'm saving tax? Not necessarily, no. Whilst there is some tax incentives, as I mentioned, as being a tax deduction for rental properties as a result of reducing your taxable income, negative gearing by virtue is that you are at a loss. So if I can put it in real simple terms, is why would you spend $1 to save 30 cents? Which I know sounds quite simple, but it's really that facet. So having a really good strategy on how you want to invest your property, in terms of how long you want to hold it for, or if it's something it's just something off the cuff, due to your circumstances, you've had to rent out your property for a particular need, which does happen, marriage breakdowns, separations, moving out from home, moving back into home to develop a bit more cash, all those sort of things in life that occur. It's really important to speak to the professionals on getting the appropriate advice around on your property, whether it is specific tax advice or finance guys, or like with Lachlan in terms of purchasing the property. So just going back to negative gearing, a negative gearing investment strategy relies heavily on property values rising. So if you hold the property over 10 years and you're consistently making $3,000 to $5,000 losses on those properties, and I'm talking cash losses, you're going to really want the property prices to jump to not only recoup those losses, but make a profit at the end of the day. So really, negative gearing, you've got to think of it as a temporary measure to enter the market, with the long-term view of getting to that stage where it is positively geared. But negative gearing isn't all that bad. It can be good when done right. So what I'll be doing in the next few slides is a couple of case studies which share very similar facts. And these ones are actually pulled directly from a client scenario that I've dealt with over the years. So Ben, if you don't mind just flicking to the next one. Case study one is just a simple scenario where the case study is positively geared. So let's just assume that your taxable income is $90,000 per annum. Marginal tax rate on that's about 32.5 cents to the dollar plus Medicare levy. Your investment property is worth $500,000 with a $400,000 loan. The loan is interest only with no principal payments at 2.6%, or it roughly equates to about $10,400 worth of interest for the year. Rent is at $400 a week, or $20,800 per annum. And rental expenses such as your council rates, repairs and other costs total about $7,000 per year. So just moving on to a quick break on the next slide of the breakdown of this. Overall, after deducting those expenses from the rental income, we've made a net profit on the rental of $3,400. So applying the marginal tax rate of 32.5% plus Medicare levy, plus all the relevant tax offsets at the moment, including ScoMo's 1080, is that your net cash position is a positive $2,125. So overall, you've made a difference to your hip pocket by $2,000 in this scenario, which is what you want. It effectively means your investment is making you money. Regardless, yes, there's a bit of tax to pay. Unfortunately, tax we can't get around, it's here to say, but we can minimise it as much as possible, which I'll demonstrate in one of my other case studies down the line. On to the next slide, I'll just demonstrate a negatively geared investment. So in hindsight, I probably should have changed some of the facts on this one a little bit later. I'll just go through, but just for the purpose of this case study, assume again your taxable income is $90,000. The property is worth $500,000 with a $400,000 loan. Again, interest rate is 2.6 interest only. Rent is the same at $400 per week, but the difference is that your expenses are additional $5,000 for the year, so totaling $12,000 for the year. So when we put that into the table on the next slide, your net profit on the rental is net loss. Sorry, I need to edit that. Is a loss of $1,600. So when you then factor that in as part of your tax at the end of the year, when you do your tax return, you do get a tax deduction against your taxable income. However, it's only generated an additional refund of $552 in this circumstance. Then when applying that to your net cash position, you've effectively lost $1,000 on this investment for the year, which is not by much. I mean, you extrapolate this over 10 years, it might work out to be $10,000, and with the view with the property prices increasing by that, it might work out quite well. However, pardon me, where you have a circumstance where you've got a really high mortgage on the loan and a really high interest rate, that's where you can get in a bit of trouble, because your net loss on the property could be quite significant, in which then you're really digging yourself a hole, because even if you sell the property, you've still got to pay that loan off. Not to mention you made a lot of losses along the years. So just be mindful of that. Excuse me. Pardon me. So moving on to the next slide is where I've just got very similar facts again. However, this is an example where negative gearing can be done right if you've got the intention of, possibly getting it positively geared over the period of time. So saying very similar facts to scenario one, albeit where I've got the subtle changes, there's depreciation involved. So for those who aren't aware, depreciation is the wear and tear on the property itself. So the structural improvements, the fittings, some type of new furniture, new appliances, all that sort of thing subject to depreciation. And there's a swath of professionals out there who can do the depreciation schedules to calculate this all for you. So makes our lives as accountants really easy, because they do all the number crunching and things like that for us. Generate a beautiful little report for us, which we can claim the depreciation up to over 40 years on the life of the property. So really good value for money. Just on the slide, there's two really good examples we use there, but being BMT and Depro. But just on this slide, so in terms of putting all those facts, the rental income is $20,800 as per before. I've factored in about $5,000 worth of depreciation, just on a straight line basis of 2.5% over 40 years. The interest on the loan is $10,400 and the other expenses of $7,000. So there is still a net loss on this rental of $1,600. However, the difference is the loss is caused by the depreciation, not your physical outgoings. Pardon me. So what we mean by that is, with depreciation, it's wear and tear. You do get a tax deduction for it. However, you're not physically paying for that. You've already done that in the initial purchase of that property. So when crunching the numbers on this, come tax time, you'll get a $552 tax refund or reduction as a result of the net loss for tax purposes on the property. However, due to the depreciation deduction and you're light on expenses, your positive cash, your positive growth in the property is that you've actually got a net cash position of 3,952. So you've actually, whilst you've got a risk on your investment in terms of generating a tax loss, it's actually generated you an extra close to $4,000 in your hip pocket, which is where negative gearing works quite well. So from the taxman perspective, he's happy. You've disclosed all your expenses and your deductions and things like that, and they're willing to pass you on a small refund for that, undertaking that risk in property investment. But overall, from a cash flow perspective, you're making money. So this is where negative gearing can be done right. And it's very important when investing in property, speaking to the likes of Lockie in terms of what analysing the growth aspects of properties. The age of property is quite relevant when it comes to tax, as well as, yes, then speaking to your tax accountant just to make sure how it can be structured accordingly so you can achieve a really good result, not only in the short term, but the long term, depending on how you wish to hold the property for. So just to summarise, gearing, as you can see from those slides, your property is geared how your property is geared has a significant impact on your bottom line. Just between case scenarios 1 and 2, the differences of those are about 3,173. So whether or not you hold the property for over 5 years or 10 years, it can really stack up quite quickly. And yeah, if you've got the wrong strategy or wrong mindset in mind, particularly if you're heavily relying negative gearing, you need those property prices to come up. So therefore, a long-term strategy is key if it's negative gearing, if property values aren't increasing. But it might be a way of changing. If you are stuck in that trap in negative gearing, it may be worth paying down debt on that investment property loan to reduce the associated expense on that and get it on the right straight and narrow. It is worth noting that the Reserve Bank generally cuts interest rates to stimulate the economy, which usually coincides with property values as well. Yeah, as a result, while rates are lower at the moment, it's a really good opportunity to reduce your debt. If you do have spare cash available, so when interest rates do rise, the cost of owning that investment property is minimised. So that's the negative gearing side of things, and just conscious of time, I do have a small section on capital gains tax as well. Pardon me, I'm really losing my voice. So just to keep it brief, the capital gain is when the proceeds of the sale of investment property exceeds the cost base. So i.e. what you purchased it for, plus any agent fees, stamp duty and all those bits and pieces they tack on the end of it. A capital gain is generally subject to capital gains tax and subject to your marginal tax rate depending on who owns it and what entity owns it. A capital loss is when the proceeds of the sale investment are less than the cost base, therefore creating a capital loss, which for the purpose of tax can be carried forward and offset against any future capital gains. So just moving on to the next slide, just some very quick facts on capital gains tax, or capital gains in general, is if you sell a property that you live in, it's considered your main residence, so it's exempt from capital gains tax. So some clients panic when they're looking to sell their family home to upgrade or downgrade and things like that, they will, what's my tax position? Well, there's an exemption on that. If you've been living in that property, that's where all your mail is directed, it's where your family reside, it's exempt from capital gains tax. The only exception to that is if you don't hold that property in your personal names, it's within another structure such as a trust or something like that. The rules may be precluded from that. Or if you have a farm that's bigger than 2 hectares, potentially there may be some capital gains tax implications. But properties purchased prior to the 20th of December 1985 may be exempt from tax. So I say may just because, you know, that was 36 years ago now, before my time. The properties may have changed from that perspective, in which there have been improvements, renovations, subdivisions, things like that. So the very nature of the property has changed. But if you've got a holder property that has not changed at all and you acquired it prior to that date, it's very likely that it could be exempt from CGT altogether, even if it is an investment. When you hold the investment property for more than 12 months, there is a 50% general discount on that capital gain. And I'll explain as an example of that on the next slide. However, that's quite important to know. A lot of people watching a lot of reality TV at the moment, where they're getting into the market to flip properties and things like that. If you're holding the asset for less than 12 months, you may miss out on quite a key concession to minimise your tax from that front. Another thing to consider is you may have made losses on not only your property but other shares and generate a capital loss. As I said before, these can be carried forward until such time that you're able to offset against the capital gain. It's just quite important to consider that you must apply the losses first, but before applying any discount. So some people make that mistake thinking, oh, I've got 40 grand's worth of capital losses. However, I've only made a 50 grand capital gain. So that 50 grand capital gain is going to be reduced by 50%. It's 25,000. Therefore, I'll use my $25,000 worth of losses and I've got 15 left over. It doesn't work like that. It's the losses first, then the discount. And then there's what we call the 6-year rule that may apply as well, which this one is becoming less and less accessible. However, it may apply where you still may get your main residence exemption despite renting out a property. So a basic example is if you've lived in your apartment for 5 to 10 years and then you get a job offshore, a temporary job offshore for 18 months, and you rent out your residential property during that time, and then let's say you decide to sell the property, just because you have lived in that property for a period of time and you've rented it out temporarily, you may still get that a main residence exemption on that. However, it's not that clear cut. It's a lot of eligibility criteria and circumstances that may impact that. But yes, it may be a possibility for yourself on there. But just moving on to the next slide. So I'll just give you a basic capital gains tax example where the sale proceeds of a property is $50,000, less your agent fees of 15 grand, and then the ultimate cost base of the property is $425,000. So what you purchased it for. So your total cost base is $440,000. Deduct that from your sale proceeds, you've got a gross capital gains of $60,000 on that property. When applying that 50% general discount, it reduces the capital gain by $30,000, which means your net capital gain is $30,000, which is subject to tax. So that, as I mentioned before, that first 50% general discount is quite key. In this instance, by holding your property for more than 12 months, you've already halved your tax bill. Sorry, I'll just move on to the next slide. Now, just some basic tax tips when investing in property is definitely just keep all your records. This includes your offer and acceptances, your settlement statements, any purchases and improvements to the property, all that sort of thing is quite key. And I know, over the years you may lose this or misplace it, but it's quite important to keep it in a safe place or even forward it to your account so they keep it on record, because this may impact not only when the capital gain tax event occurs, when or your tax implications in terms of your capital gains concessions, and also forming your cost base to minimise your exposure. So like I said, it also includes any receipts for any structural improvements on those properties as well. So if you've done the bathroom, the kitchen, had to repair the roof or redo the flooring from carpet to hardwood floors, all that sort of thing does form part of the cost base and really helps reduce your capital gains tax down the line. When it comes to renting your property, highly do recommend getting an agent to manage it. If you do, be sure to get a copy of that annual income and expenditure summary. Really comes in handy when it comes to not only working out how much you've made off the property, but does make our lives easier as accountants to put it all into your tax return and just save time on costs on that. The next tip on there is just to get a quantity surveyor's report or depreciation schedule. So as I mentioned before, it's one of the main keys of investing in property and claiming your depreciation back. As I mentioned, you've potentially spent $400,000 on property. What benefit you get? Well, you do get a 2.5% on any capital works or the physical structure of the building over a life of 40 years, which can quickly add up in terms of tax saving down the line. Probably just one thing I'd be aware of is there's different types of depreciation. So some on your plant and equipment, which is Division 40, your fixtures, your fittings, all that sort of thing. But if it's capital works deduction on the structure as a whole, when you do sell your property, it is added back on top of your cost base, which can catch people out. So just be wary of that when getting depreciation reports. But generally in the long run, it'll work out better for you. On to the next slide. If you do plan to sell your property, generally speak to your accountant to plan the transaction in advance, whether that's part of tax planning or just to get an idea of what your tax exposure is or whether it is one of the right times to sell. Another item is if you're looking to undertake a complex property development, i.e. a subdivision, or like I mentioned before, flipping property, it's really good to get advice and get some clear alignment on what your intention and strategy is. Now, I could dedicate a whole section to this purely because depending on your reason of selling or the very nature of your intention of what you're trying to do with the property, has very adverse, contrasting, should I say, implications on tax. Just to give you a basic example, if you're looking to purchase a property within a few months, develop, renovate it and then improve it and then look to flip it 6 months later, the ATO would see that as you're looking to carry on an enterprise, a profit-making venture, and therefore treat any proceeds on sale as revenue account. So what I mean by revenue account is it's taxed at your marginal tax rate or the applicable tax rate of a particular entity, whether that be a company or if it's in a trust, it might be a distributed to your beneficiaries and assessed at that marginal tax rate. However, the key thing is because it's on revenue account, capital gains tax concessions don't apply. So your 50% junior discount is lost. However, there's different treatments on your GST, you'll have to register for an ABN, all that sort of thing. Whereas if you decide to hold the property for a long period of time, i.e. you've done a subdivision at the back lot, you build it and then you want to rent it out for 5 or 6 years, however long, and then you decide to sell it, well, the view is your intention was a long-term strategy. It wasn't a profit-making venture at the time, i.e. being a business in developing property. Is more of a one-off circumstance, so that would be get assessed on capital account, and therefore you'll have access to potentially the 50% general discount. So be clear on what your intention. I know life changes and things do change overall. However, just be clear from the start what your intention is to do and devise your strategy from there. The last tip is just structure your investments accordingly as well. So again, conducive to whatever strategy you're looking to do, but there are different types of investment structures that can be tailored to your needs that can legally minimise your tax as well as boost your overall wealth. So some of you here today may be familiar with, the concept of a property trust, or if you're in the game of developing property and flipping them quite quickly, you might look at a trading company, for the flat tax rate. Some people might purchase property within a self-managed super fund, which is a whole new game altogether. So I suppose what I'm trying to say is not one size fits all. It's really determining what your needs are, what's your overall strategy. I suppose in essence, your life plan. How do you see structuring your investments to boost your wealth overall? And then let us tailor a strategy for you overall to not only achieve that, but make sure we get the right structure in place to facilitate it as well, because there's lots of different types of possibilities and options out there. So without further ado, that's it for myself from the tax side of things. I suppose I might just put it to the floor with Paul and Lachlan if there's, I suppose, any questions that anyone would like to ask.
Yeah, thanks, Ben. It's really good information there. And one of the key points I think that's been raised by all four of us is before you do anything, perhaps check with your accountant, check what structures you want to look at getting into the property, check your finance position, hopefully through us, and then also use a professional like Lachlan to maybe look at your potential best suburbs or best locations to buy in. So any questions at the moment? I'll ask our facilitator, Benny Hart, if he's received any that have been typed in. If not, I might let you go since we've run a bit over time.
Yeah, no, none through at the moment. I have opened up the chat if anyone wants to pop anything in there, but yeah, if not, we'll we'll wrap it up.
All right, thank you again for everyone for attending. If you do have any questions, you can just send them through either email us direct, and we'll get back to you. And as I mentioned before, the presentation today will be available on our website, and we'll be able to send that out to you as well if you want to obtain a copy. Thanks very much, and have a great day.